Hello, everybody. This is Noah and John, and we are from UrbanDigs, and we are talking Manhattan. And Johnny, we got Jonathan Miller here today.
Yes, we do. Master of the universe himself.
That's right. That's right. Self-proclaimed.
Can I have you talk to my sons just to confirm that? Because they don't feel the same way. So,
well, we feel that way, Jonathan.
Okay,
so, and I'm
fair
sure
enough.
The world feels that way.
Fair enough.
But anyway, Jonathan Miller of Miller Samuel, thank you so much for coming. Appraisal King. I mean, listen, it's crazy town right now. What's going on in the markets?
Yeah.
On a liquidity level, it's just through the roof. But let's just stay grounded for 1 second and let's start this conversation off at a higher level of what's going on in the New York real estate market.
Right. So that's sort of like when the dentist is like drilling your cavity and your mouth is full of, all kinds of equipment. And the dentist says, so what's new? So what we really have seen is the phenomenon is that Manhattan is catching up to the rest of the world or the rest of the US or the rest of the New York metro area. The first quarter report we published, Douglas Elliman came out last, time flies, 2 weeks ago, that for the first time, the closing data actually showed parity with the year ago level, which I think was symbolic. Of course, the outer boroughs and everybody else have been doing that for a while. Manhattan was late to the party, but it is in the party now, I guess you could say. And we're measuring, we're seeing it in sales activity. Pricing is still in aggregate is behind, but we are seeing, definitely some upward price pressure in some of the price bands. At the same time, we're also looking at a rental market that also has seen a tremendous amount of new leasing activity, which, part of it's musical chairs, moving around to getting better deals on apartments.
Right.
But we're also seeing the rate of descent in price still significant year over year, down, in the 14, 15, 16% range, depending on the segment, but that's down from 20 to 25%. So definitely improving. And we've seen month over month, new leasing or net effective median rent not go negative for 4 months in a row. Journalists live and die by 3 data points make a trend. So we could say 4 shows that we're sort of seeing, we're not proclaiming stabilization, but we're seeing things moving in that direction, meaning that, one of the things I'm sure you guys see it the same way is that, when a market turns, let's start back up and say, when a market is going in a certain direction at a steep rate, whether it's up or down, participants in the market say, well, the market's going to rise, basically forever. It's just this the way it is. Or when prices fall, it's going to fall forever. We're very linear in how we think about housing price trends. And time and time again, we learn that that's absolutely not the case. And so, so much is predicated on, in terms of the rental market, on the sort of return of office workers. And that's predicated on the distribution of the vaccine, which is going, despite the Johnson & Johnson hiccup the other day, we're 4 million doses a day. I mean, who would have thought? And so the sooner corporations start pulling employees back, the default was September, but we're starting to hear, earlier, summer, June, May, we're starting to hear that, but not in mass, but we are definitely seeing it, that is another acceleration in demand, because when the office workers come back, I think that's going to be of key benefit to the renters, the rental market. And it's also going to be a key benefit. It's going to pump a little oxygen into street level retail, which is part of the optics problem that Manhattan still has. Central business districts look like a dystopian hellscape. And the residential neighborhoods, they're not normal, but people are running around, dining outside, everybody's wearing a mask. Like, it feels like night and day.
Yeah, no, it's a great point. And, if I could just add on to this, Noah and I did a piece about what the recovery is going to look like and sort of a checklist for it. And, we had, sales, rentals, we've got the liquidity back, the prices we're working on. Same thing for the rental side. We've got that liquidity coming back. We've got those leases signed. We're still waiting on some of those prices to start, coming back. And I think you're right, Jonathan, that we're sort of waiting for the vaccine and office markets to open up. But, and that's kind of where I'm going with this, is that one big sort of elephant in the room is, what's happening in that commercial office sector and what's happening, especially with the ground floor retail. And I'm curious if you have any insight into either of those sectors and sort of how they play on, also with schools opening and how that necessarily plays on, real estate in and around those areas like Midtown, financial district, et cetera.
Well, they're all variables. Like, just imagine we're in a circus spinning a lot of plates in the air. That's the way this is. So there's so many variables. We don't really know what human behavior is going to do in terms of how quickly people adjust. I mean, the bottom line is that people don't feel safe, but they're feeling safer every day. If I could sort of, assume that based on interactions and observations. And it's a gradual process, and 2021 is this gradual process. What that's going to end up doing is you're going to have, the way to think of the commercial office space world is, so many of the big buildings are 80 to 90% empty still. And so we talk about, we're going to be this remote working society. Well, pre-pandemic, the 100% remote workers were like 5% of the employee corporate, world. And so if it doubles or triples, that's 10% or 15%. I think the bigger tranche in sort of the office worker profile is going to be, you're going to have this huge increase. It's probably well over half the market of hybrid. People like myself, where, for the last 12 years or 13 years or so, I always work at home on Fridays. And so I'm a 4-day, 3 to 4 day a work person. I'm probably going to be a 2 to 3 day. So people that were 5 are going to be 4, 3, or 2, there's going to be, so that the square footage needs for, the footprint of most companies is going to dilute, over time. But people, I think, are mistaken if they think that where we are right now, and I probably said this last time we talked, we're at peak Zoom. Like, this is not the norm. This is an extreme end. We're not going back to where we were, but we really don't know how it breaks out, other than I think we're going to end up being, we're definitely going to be in between where we were and where we are now. Where we are now is not a proxy for the sort of, post-pandemic working world. And that's going to actually, in a weird way, and forget like common sense for a second, just sort of look at aspirationally, is that it brings in or creates some sort of youth renaissance where you have younger companies coming in that can afford like Class A retail. I'm not saying, just companies that were sort of just priced out. You're going to see a lot of that happen. The people that are going to be hammered are going to be landlords. I mean, no doubt about it. Like, they're already hammered. And that is going to stay with us. Retail, I think, cycles out pretty quickly because it turns over quickly anyway. So I'm pretty confident that once you have oxygen being fed to the economy for street level retail, you're going to have more occupancy, and it's going to be different. It's not going to be all luxury stores like we've had an oversupply of. It's going to be a little bit more gritty, I think, which is the New York that I love.
And I just want to touch on that for 1 second, because I mean, you're going to have so many new ideas coming in. Like you touched on, there's a macro shift in how we live and behavior is going on right now. And that shift it's not set it's almost like it's like moving it's concrete that
it's
hasn't
being
set
painted.
yet.
It's being painted right now.
Yeah, it's evolving
But
as
there's
we
only
go.
like a
And
little stick person in the corner. Like,
yeah, yeah, and it's and
we
what it
don't-
looks like now is not is a peak of what it's going to look like in the future, but it's still kind of finding its way. And
Agreed.
you touched on some things. We wanted to talk about how the recovery is going to make up and look like. And for the last few minutes, you really made one central point that just stuck out with what you were saying, is that there's so many tentacles to this beast. There are so many different parts of the buyer pool. We talk about this, John, of the buyer pool that's not yet online. I like to say we're operating at half capacity. Even though I don't know what the hell half is. We're not measuring anything. I'm just, 40, 60, so who knows? We're not at full capacity. And you mentioned ground floor retail, which if you wait for ground floor retail to come back, you missed it. Okay.
Right.
If you're going to wait, when ground floor retail comes back, this market's going to already have the dynamics in play, propelling it into a new kind of paradigm. And if you wait for that, I think you're going to miss an opportunity, because right now, like you said, it's very clear the prices we're back, but we're not really, we haven't done what suburban markets have done. We've done the opposite. Right. So let's switch to that, because we have brokers listening, and let's talk about prices. How much are we down in this COVID crisis? Like how much do you think we went down in the COVID crisis? And how much are we down like today? When you're looking at deals, you're an appraiser, deals getting done today.
Yeah, we're seeing values pushed upwards. I mean, you're seeing you're sort of seeing that tension. And so there's a couple of questions you asked. So let me try to go through them. First is, if I had to generalize super macro on prices in Manhattan, and controlling for the skew to larger size sales, which is skewing prices higher, like our median, we're seeing somewhere between 5 and 7% prices off pre and post COVID. But that means, we still have, bidding wars, we have stuff selling over ask, and we have stuff that's selling, way under ask, we have the whole, so it's a general statement. It doesn't mean that everything is off that amount.
It's a mixed bag.
Yeah. Right. It's a mixed bag, just like it always is. Right. But, but we still are seeing a skew in square footage. Average sale size in the first quarter was about 10% higher than the year before because of unemployment, because sort of the lower wage earner, has been cut off at the knees. And so but we still have a lot of softness at the very high end of the market. So sort of the middle, if you could call it the middle, sort of moved up a notch. And that's caused aggregate pricing to rise, but it doesn't mean prices are rising. It's a shift in the mix. Yeah. What was the other? I forgot what the other question was.
Deals going on right now.
Oh, yeah.
For the most part, you said it's a mixed bag right now, but there is upward price pressure happening.
Yeah, we're seeing that in the appraisals that we're doing. That we're definitely seeing, some tension, and we're seeing, pretty quick marketing times. The point I wanted to bring up was, from an sort of the optics, I was talking about the optics of Midtown versus like the Upper East Side, in terms of, the camera shot pans over Midtown, and, it's a dystopian hellscape, and you've got boarded up buildings and boarding up retail and piles of garbage. And it's like, oh, that's Manhattan. No, that's not Manhattan. The other misnomer is that we're like wildly oversupplied. There's so much inventory because the market choked. And, inventory from its peak in the summer is down about 25%, give or take. It's still about 10, 12% above the 20-year norm. Now, I say 20 years because I physically put this data into my spreadsheet every month for 20 years. So do not take this number lightly. Right. These are the numbers. So from a long-term historical trend, inventory is elevated, but I'm talking, we're pushing aside super luxury, your sellout, the super high-end stuff, but just the housing for mere mortals. We're really talking about, elevated inventory, but not any kind of massive oversupply. And I think that combined with sort of this tension, concern that rates are going to rise, you have this pressure. And so the way I look at the spring market is you have the seasonal, it's the spring, and we can see from listing inventory patterns that the market, 2020 was not a seasonal pattern for anything, because of the pandemic, but we can see things starting to revert to seasonality, and spring is the, Super Bowl or the World Cup of every housing market. And so you have that combined with the momentum coming out of, with the COVID vaccines, my dad joke, it's the V-shaped recovery, V for vaccine. That is, going to, continue to really press this market, create some tension in the coming months, I think.
No, that's awesome. And I wonder if we could just shift a little bit to what's happening in Brooklyn, because Brooklyn was sort of first out of the gate. And I don't know if it's necessarily something that's related to what you talked about, how sort of the lower wage earners were sort of cut off at the knees. But the whole idea is that you could get more for your money in Brooklyn.
Right.
And that's still the case. But, we've seen the median price in Brooklyn sort of, keep ascending. And I think it's probably, if not right now, but close to record highs. And volume is just off the charts. Could you speak a bit about what's happening in the Brooklyn markets like right now?
Sure. So the way I think of Brooklyn is think of Brooklyn as Fairfield County or Westchester. The outer boroughs behave like the suburbs. And so it's interesting, again, not to overuse the word optics, but when we think about the outer boroughs in the beginning during the pandemic and the lockdown, and and this sort of like, urban was bad, suburban was good in terms of safety, and we know that was actually not true, because Manhattan, had the lowest infection rate and the highest density, right? So it became this urban to suburban, and then it really morphed into, well, it really was Manhattan versus suburban. And then it really became Manhattan versus suburban and outer boroughs. Mm-hmm. And so Manhattan is the sole location that really was late to the party, so to speak, because, as I cover like 36 different housing markets across the US, and everywhere but Manhattan was booming, has been booming. Yeah. Brooklyn, Queens, no exception. And it was heavily dependent on the sharp drop in mortgage rates during the pandemic lockdown. But remembering that the momentum for the prior 18 months, rates had already fallen down because of the trade war, to avoid a recession and all that. So you have this like insane low rates. Now they've ticked up a bit, but like 50% of people that have a mortgage in the US have a 4% or lower rate. So I don't start getting worried about volume or transaction volume until unless rates sort of start drifting above 4%, would be my thinking on it. So this is a unusually heavy rate dependent sort of phenomenon that is happening everywhere. I mean, I cover LA, there's wildfires, last year. And the market, you could see like burning trees, and there's like, 30 people at the open house. I mean, it was insanity. And it's this combination of sort of release from a lockdown combined with unbelievably low mortgage rates that,
and I don't want to even think about where mortgage rates might be in 5 years or where inflation might be going in the next 5 years. But, if you have an investment thesis,
I don't think inflation will be, I think that inflation will not be a factor. And the people that are worried about it are people that grew up, that are our birthdays, like in the 60s, whatever, versus 70s, people that were born in the 70s, because in the 60s, or when I was in college in the 70s, of stagflation, and the way inflation works now is completely, in my view, different. So I'm not an authority on it, but I'm less concerned about it. The other thing is, the other thing, just to sort of double down on the conversation about the spring market, is that what's GDP going to be forecast? What is it this year? It's like triple what it should normally is because of the stimulus, and next year it's going to be like more than double. So there's all this sort of external forces in terms of that will be benefiting the workforce. So I'm on the sort of camp of pretty quick economic recovery for the city. And I think that benefits housing everywhere, not just sort of an oversized benefit to say Manhattan.
Yeah, and I agree with that. I just think it's going to be a 5 to 7 year. Quite frankly, I think inflation is coming. I'll agree to disagree. When I look at the 2008-9 crisis, we printed about $1 trillion. This time is going to be 7, 8, 9 trillion. I think that will funnel through over years. But you mentioned the rotation.
It very well. I'm not the definitive person.
We'll stay away from inflation, deflation. Yeah. You mentioned the rotation. You mentioned the rotation from suburbs went vertical, urban went down, kind of thing. And there's a long runway here, Jonathan. Like we haven't even. I mean, would you say that we recovered the COVID discount at this point right now today?
I think we're going to see that in the closing data next quarter. In the second quarter. So the contract activity now, I think we're getting. Like there's no discount, or
that's what I'm hearing.
There's no discount. I and if it's not, if it's not, it's close. And maybe it's the third quarter, and that assumes a lot of things. That assumes the trajectory continues, the logic continues, the success of the vaccine continues. I feel like a lawyer because I have to caveat with like 37 disclaimers because, like I said, we're spinning plates. There's so many variables we don't know, but that seems to be the path and what seems to be the trajectory in terms of where we're moving.
Right.
And one other thing, I'm sorry, just one other point on that is that, again, I still think that the sales market has an outsized benefit or is a better performing asset class than the rental market, because I think ultimately the rental market, the unemployed, the wild card is, do those people, if you think of lower wage demographic, well, they tend to have higher probability of being renters than property owners. So, that's a longer recovery than the sales market, I think, when we talk about Manhattan. But nothing like, it's a decade. No, I think it's maybe a year or two, based on what we see now.
Interesting stuff. I not to beat a dead horse, but one of the things that Noah and I were talking about months ago was that it seemed like with the suburban markets going up so fast and the urban markets sort of trending lower, there you could picture Manhattan somewhat strangely as a value play, and I'm not sure if that still holds true. But I'm wondering, if you look at suburban prices, are they still sort of on an uptrend, on a steep uptrend? It's amazing.
Yeah. So more than a third of all the sales in Westchester, for example, that we published last week, sold in bidding wars. A third of everything that closed, and that's up
I've seen this
nominal
before.
amount from the prior quarters. What's that?
I've seen this a few times before.
This always has a happy ending. Don't worry.
Well, okay. So the point, like when you bring this up about the suburbs and sort of the interaction between the city and the suburbs, I think. I'm just speculating here, but when we think about how consumers and brokers think about the city, about Manhattan in the relationship to the suburbs, I think that the perception was, it's I'm trying to think of the word for it. I'm blanking out, but one goes down, one goes up. They're inversely related, right? Because the narrative about the suburbs was fleeing the city, exodus. We're packing up the truck and we're moving to Westchester, whatever. And that logic actually was incorrect. That was part of it, outbound. But it wasn't the whole reason. The whole reason was there was tremendous inbound in the suburbs or rental to buyer because of mortgage rates. And it wasn't just everybody packed up and moved out of Manhattan, but there's that sort of connection between the two. And now that the city seems to be doing a little, has been doing much better and, sales activity is, pretty, strong relative to better than last year. That has to come, zero sum game. I'm sorry, I was blanking out, but the Manhattan's success has to come at the expense of the suburbs. And I can tell you in the data, that is not the case.
Not yet.
What we're seeing
not
now.
Yet. But
yeah,
not yet. I think that will happen. There will be a rotation at some point.
That's possible. I'm not disagreeing with that logic. But the one thing that is different than past cycles is that there's a residual leftover from the pandemic, and that's Zoom and remote working. So I'm not saying that 50% of people that work in New York are going to live in Westchester, Fairfield, whatever, and never drive in. But there's like a subtle sort of difference, because you are going to have people that are going to live further out in the suburbs because they only have to commute 3 days a week.
Yeah,
so I think there's a lot of
been happening
people
for the last
and this is one of the things, Jonathan, you brought up last time we talked. You talked about this idea of this co-primary, which is that you're living farther out because you're working a few days.
Well, you're supposed to say co-primary, then trademark,
right?
Even though I don't have one.
A little JM up there, a little circle. But let me just shift now, if we could, as we're sort of winding down a little bit. I'd like to talk about the appraisal game right now, how banks are seeing things, how you as an appraiser are seeing things, given prices are sort of in flux. And if you give us a little guidance there, if you're an agent out there, what do you need to know about how appraisals are coming in?
Sure. So, and this is, I'm actually speaking in the context of national as well, because it's the same everywhere, where you have a housing market that's characterized by beyond chronically low supply. Everywhere in the US, there's just not enough supply, combined with a strong, overpowering demand that even with rates, although refis are down because rates have ticked up a bit, but there's still it's completely out of balance, right? And so what the problem was the last 6 months of 2020 was the data set was half, right? So it was very hard to find things post lockdown. The volume, in terms of, because we have to provide a minimum of 3 closed sales, but we're not basing it on closed sales exclusive. We're basing it on contract data that we have and listing data. But when you have less data and you run into quirky properties, it was very difficult. That is much less the case now. Because of more data. And I'm speaking specifically in Manhattan. Because we're seeing more activity, there's more data, but one thing to keep in mind is that mortgage lenders right now, and whether it's right now or during the lockdown, are more weighted towards a conservative outlook than the historical norm. And the historical norm means prior to the housing bubble. Way before that, but just, over the last 50 years, and you skip the housing bubble era, and then you come to now, underwriting is skewed. It's not like it was right after, Lehman went under, but it is not normal. And so so that's why I feel pretty good about, and I'll actually answer your question in a second.
So let me say, you're saying banks are not lending.
No, I'm not saying that. I'm saying that they are lending, but they're not flexible, right? So
they're much tighter in their funding.
They have they have a respect for risk that they didn't have at all during the housing bubble, where you just need a pulse or fog a mirror. It's not like that. We all know that. And that's a reality. So they do look to the appraiser more than ever before, or not ever before, but more than they did in the last 10 years. And so they really, and our industry has tons of problems with that, with, the automation and all, AVMs and all that sort of stuff. But so we're finding it challenging, but for data, but we're not, beyond that, we're not finding, you know, it's really just a quantity issue of data. So there's
Yeah,
not
you know,
the same,
John, I was
there's not the
telling
same pressure for speed like there was during the bubble where you need to do things in 5 minutes. You know, it's much more normal and balanced now, which is also encouraging, because taking an extra day of due diligence on a 30-year lending exposure
Right.
seems reasonable to me. And that's the way we're seeing
And
it.
John, you know, he's basically saying we had no data last year. I mean, like, let's just sum up. We had no data. We had 7,000 transactions in Manhattan last year. We typically have over 10. Okay. So transaction volume was down 30%. And I could tell everyone, guys, when you have data volume so low, the numbers go all over the place. And
there's a lot more volatility in the trends.
It's very volatile. It's very illiquid. You can't just see, oh, the market's down 7%. It's very clean and clear. That does not happen. And now you're in a period right now where you have 4,700 pending sales. You're going to get so much price discovery over the next 3 to 6 months that it's just going from nothing to something. And it's just a weird thing.
Well,
and while it's doing that, you have all these other, you know, like I said, plates spinning around, right? So we have all this price discovery things happening, but there's still not tremendous certainty. But it's moving. There's sort of light at the end of the tunnel, and you know, so that's sort of the commonality of it.
So just the last question: if you've priced something and you just go Manhattan condo, co-op, large unit, you price it low to get the offers, it comes in, it goes way over ask. Is it going to appraise if we're going over ask? This is a new podcast. Will it appraise? We could just do this.
Will it appraise? Exactly. Yeah, and its competition is the podcast called "How to Hit the Number," right? So you know, and this is, you know, a common thing, you know, in tight markets. You know, in 2015, we had bidding wars in 31% of the transactions, right? Now it's like 3 or 4% and rising. So the answer is it should, if it's an appraiser with local market knowledge, right? Somebody not from Albany driving 12 hours because they were the low bidder on an appraisal, right? There's plenty of that stuff that's still happening, but not, it's not as reckless as it once was. So I feel better about that. So it's beholden to the broker or the agent to share the story of the transaction, the anecdotal story. Like, I can't stress that enough. The conversation you have with the appraiser is your one and only chance to accurately portray what happened, because once they walk out the door, you have no access to them ever again until the next sale you run into them. And what you should be telling them is, we put it on the market in 48 hours. There was an offer and 5 backups and blah, blah, blah. You know, like, that's so important. I can't tell you. If you have an appraiser that tells you, I don't care about all that stuff, I just need, you know, the closed data, or, you know, give me a contract. That's when a red flag should go up, because we care about that stuff. Because the anecdotal, especially in a market that's changing, you can't hang your hat on public record as the sole bearer, because public record is slow. And in Manhattan, it's inaccurate, as UrbanDigs will tell everybody. It's a rear view mirror look. Yeah.
And it doesn't tell the story.
So, you know, and that's the way I'd look at it. A good appraiser is going to, you know, be curious about what transpired, or, hey, there was a contract, it went for the same, or it went for a higher price and the deal fell through because of their credit or whatever, and then we put it back on and it got 5 more offers. I mean, or, you know, it doesn't have to be that extreme. You know, if it's not that extreme, it could be something less. And also sort of, I don't know, you know, be candid about the sale. Like, how did you price it when you listed it? I think that's important. Give them data. Give them a 1-sheet piece of paper with the data that you think is relevant, that they can verify.
Yeah, tell the story. I don't think agents understand that from an appraiser's perspective. A lot of them look at it in terms of, is it a stable market? Is it a declining market? And it is a rising market. and we have just been through an extremely fast moving market, down, up, like it's just,
right.
and those type of markets, when everything's so fast moving, the active and in contract world becomes more and more and more critical, because that closed is only going to show you what happened 5-6 months ago.
Right.
So if the market,
but the problem we have, and I don't know if you guys track this, but you know, is you know, what's the share of deals that blow up? Because I would imagine it's pretty high. I would imagine.
We'll have to check in. We got to go. But obviously we have things to talk about. So we'll bring you back and we'll continue this conversation on an ongoing basis. But
listen,
Jonathan Miller.
I got like 22 years left on my mortgage, so I'm around for a while. So anytime, always fun to talk with you guys.
Thank you. Jonathan Miller of Miller Samuel. That is John Walkup. I'm Noah Rosenblatt. We're both of UrbanDigs. This has been Talking Manhattan, and we'll catch you next time.